Welcome to The Explainer. Today we're digging into a real head-scratcher, a trend that's quietly reshaping the entire American economy, the incredible shrinking stock market. So why are so many companies doing a disappearing act?
Well, get this. Since the mid-90s, the number of publicly traded companies here in the U.S. has just tanked. It's gone from a high of over 7,000 to about 4,300 today. That's nearly half the market just gone. So the big question is, where in the world did they all go?
To get our heads around this, you've got to understand two massive forces at play. There's a push factor, something that was actively shoving companies away from the stock market, and then there's a pull factor, something that was luring them into a totally different financial universe.
Let's start with that push. And honestly, this quote from a private equity titan just says it all. I mean, when the CEO of one of the planet's biggest private equity firms says a law is the best thing for his business but one of the worst for America, you know something huge is going on.
He's talking about the Sarbanes-Oxley Act. You might have heard of it as SOX. It was passed back in 2002, right after those massive scandals like Enron. Now, the goal was noble, protect investors. But here's the kicker. It had this massive, unintended consequence. It made being a public company incredibly expensive and complicated.
All of a sudden, public companies felt like they were drowning in paperwork. They had to deal with intense scrutiny from investors, the relentless pressure of hitting those quarterly earnings numbers, and the costs? Oh, the costs were absolutely jaw-dropping. By one estimate, the median cost was over 4% of a company's entire value, every single year. A lot of CEOs just looked at that and said, you know what, this just isn't worth it anymore.
But here's the thing. This wasn't just an escape. It's not like these thousands of companies just packed up and went home. No, they were migrating. They were running directly towards a huge and fast-growing pool of private money that was waiting with open arms.
And this is where the story gets really, really interesting. Right as companies were getting fed up with public life, this new private empire was rising up. It was ready to fill that void with trillions of dollars in cash, all while playing by a completely different set of rules.
Okay, I know this chart from CalPERS looks like a lot, but stick with me, because it basically tells the whole story. It all starts over here on the left, back in the 90s, when big banks started merging. They got bigger, so they focused on bigger clients, which left smaller businesses out in the cold. Then the public markets did the same thing, focusing on the big, flashy companies. This created a huge funding gap. So who jumps in to fill it? You see it right here on the right. Private equity and private debt just exploding onto the scene to fund everyone else.
And when I say exploding, I mean it. The growth was just staggering. Since SOX came into the picture in 2002, the amount of money managed by private equity firms has quadrupled. It's like someone took a massive fire hose of cash that was pointed at the stock market and just redirected it into this new private world.
And right here, you can see that direct relationship in action. On the left, you see the number of public companies just falling off a cliff. At the exact same time, look at the right. Private fundraising goes through the roof. The two lines are almost a perfect mirror image of each other. And then you get to 2015, and boom, for the first time ever, more money was raised in private markets than in public ones.
So what's the bottom line here? All that money moving around had a massive real-world effect. The number of U.S. companies owned by private equity just skyrocketed, increasing by more than 5 times. So you see, the companies didn't really disappear. They just changed owners and slipped behind this private curtain.
Okay, so this is where the story pivots and starts to involve you and me. For decades, this whole private market thing was a world reserved for the super rich. But now, that private empire is starting to open its doors to everyday people. It might even be coming to your 401k. But before you get too excited, it is absolutely critical to understand that these two worlds play by completely different rulebooks. Your 401k, it's wrapped in layers of protection. It has to be transparent, and it's governed by what's called a fiduciary duty. That's a strict legal requirement that says your plan manager must act only in your best interest. Private funds, though, they have much looser oversight, and some of those key protections, like that duty to act in your best interest, can actually be waived in the fine print.
So before you even think about jumping in, financial experts say you need to stop and ask yourself some really tough practical questions. First, there's liquidity. Are you really okay with locking up your money for maybe 5 or 10 years? Then, fees. Do you understand just how high and complex they can be? You've got to think about your risk tolerance and, of course, transparency. Are you comfortable with knowing less and having fewer rights?
First up, and this is a big one, liquidity, or really the lack of it. Unlike a public stock that you can sell with the click of a button, these private investments are illiquid, and that's a huge difference. It means your money could be locked up, completely out of reach for 5, 7, maybe even 10 years.
Next, let's talk about the fees, because they can be a whole different beast. Private fund expenses are often much higher and way more complicated than what you see in public markets. We're talking about things you'd probably never expect, like the fund manager's private jet travel getting billed back to the fund, or being charged for back-office services at a profit.
And finally, transparency. For a long time, the government basically had a hands-off approach to private funds. The thinking was that only super rich, sophisticated investors were playing this game, and they could fend for themselves. That means fewer required disclosures and way fewer protections for regular people who are used to the bright lights of the public markets.
So, with this massive shift in the financial world well underway, where does this leave the average person? You know, someone just trying to grow their savings for the future in this brand new landscape.
All right, let's recap the whole thing real quick. The public stock market is shrinking, period. Companies are running from the high costs and intense pressure. To fill that void, a massive, multi-trillion-dollar private market has risen up. And now, that once exclusive market is opening its doors to you. That could mean new opportunities for growth, sure, but it comes with some very real risks. Your money is tied up for way longer, the fees are a lot higher, and you just don't have the same protections.
And that leaves us with the billion-dollar question that everyone, from government regulators to future retirees, is asking right now. As this private, exclusive world opens its doors to Main Street, will it be a golden staircase to Wall Street-level returns? Or is it more like a rickety ladder leading to a whole new world of risks that the average investor just isn't ready for? The answer is going to shape the future of investing for an entire generation.